moving on to the balance sheet, it's a very, very rosy picture. Alibaba is in a very, very strong and good position. Touch wood, unless they're gonna be forced and strong-armed to donate to the Chinese government. If not, so this is all you need to know from Alibaba's most recent record-beating quarter. So to ensure some level of consistency, before the recording of today, I actually dawned upon this shirt with this llama logo printed on it. Llama actually signifies some level of mystery and also surprises. And of course, we know from this earnings, Alibaba did pose a certain level of surprise to many analysts on the sidelines. However, I think before we go into the earnings proper, I just have some rant that I wish to vent out, some level of frustration that I wish to explain to fellow Baba investors. So I think for those of you who have been early investors of Alibaba, you guys are probably tracking the financials of Alibaba since, say, 2018, 2019. That's a good 5-year track record and time frame to really understand how the business is developing and growing and stuff like that. But I think this was an Excel sheet that I've showed multiple times on my platform. And you know that I think over the last 3 to 5 years, they've actually changed how they classify and report their earnings at least 2 times or 3 times now. And it's a little bit frustrating, especially for serious investors that want to do some sort of modeling or some sort of presentation. Specifically myself, because I'm a YouTuber that talks mainly about Baba, I want to create some beautiful graphs to kind of show you the trends and stuff, but I really can't. Because you can understand that I think the first time they changed was back in 2021. This was enacted in December of 2021. They started breaking down the core commerce segments, and you have multiple verticals like the China commerce, LCS, which is local consumer services, Cainiao, etc., etc. But previously, everything was essentially lumped up into core commerce. And right now, in the most recent earnings, they further moved around and reclassified because we know that there is this 1+6+N new business strategy. They then changed their accounting again. And maybe I shouldn't say accounting, but they changed how they classify and recognize different revenues on the different business verticals. And of course, some of you will bounce back, especially skeptical investors will say that, oh, Chiking, are you not afraid that they're playing with some sort of accounting numbers and how they classify their business and how growth is being distorted, especially when you can just keep reclassifying and adjusting your positions? And I think here is what I wish to talk about today and to really appease some of these discussion points. And of course, the biggest frustration that I wish to vent here is, why are you not smashing the cute little like button? It's free of charge. So it's true that if you really want to focus on different business verticals, there is definitely some level of complication. But really just to compare some of the top line numbers to give you a flavor and a feel of how Alibaba as a business have been transforming over the last, say, 5 to 6 years, you can see that revenue essentially doubled from $115 billion renminbi to $234 billion in the most latest quarter. And you can see that operating margins essentially peaked in June of 2020 and started coming down in 2021, 2022. And it essentially coincides very nicely with the tech crackdown, which lasted for the last good 2 years. However, I think the trend is important, and at least in the latest quarter, you can see that margins continue to improve, and we are also expecting some level of normalization from the tech crackdown and how they're going to move on with the developments, with new regulations and also new partnerships moving forward. Now, furthermore, on top of top-line revenue growth rates and also bottom-line operating margin, there is also one key segment that many investors are interested in, which is the profit share contributed by Ant Group. And Alibaba did kindly provided that breakdown, and you can see that throughout June 2020 to June 2023, it's in a similar trend. It started peaking in June 2021 because of the crackdown, probably new regulations of how Ant is going to conduct their business. There's a huge plummet in June 2022. And of course, in the most recent quarter, we can see that there's a very strong recovery, albeit not recovering back to 2021 levels, but at least, like I said, the trend is moving in a very positive direction. Now, moving on, I think in terms of you trying to understand the revenue growth rate, because investors might push back and say, oh, revenue doubling in 4 years is not spectacular. But let's not forget that in terms of ranking, Alibaba is the 58th biggest publicly listed company if you rank them by revenue. And you can see that at rank 68, Meta Platforms, It's at around $117 billion top line. And also a fun fact here, Meta also doubled their revenues in 4 years, exactly like Alibaba. Which is why I alluded to the fact that in a few videos ago, I do think that Alibaba models very closely as an advertising company. So much so that in terms of their top line revenue growth rate, it's exactly the same as Meta platforms. Now, moving into the earnings report proper, this is essentially the different segmental breakdown of the different growth rates and adjusted EBITDA that Alibaba provided. But I think it's more useful to zero in to the different individual aspects because we know that in different industries, specifically Taobao Tmall, which is the China commerce business, versus Alibaba's international commerce arm, there are two different animals. They are experiencing different headwinds, different tailwinds. But I think to just focus into the Tmall and Taobao group, you can see that I did put a red box there because they are essentially driving the entire business of Alibaba group. They are the most profitable, they're the highest margin, and they take up the biggest revenue share and profit share of the entire business itself. So that is probably one of the biggest concerns for many current Baba investors. And also, the second part, which is cloud. Cloud, as many investors put it, it can be seen as the crown jewel of Alibaba, which will be the next growth curve or S-curve, as some of you might like to put it. But of course, in terms of the cloud business, it's growing at a much slower pace at 4%. And we will explore why later on. So after looking at top line revenue, the next line item we are interested in is probably expenses. And you can see that Alibaba's management team did deliver in terms of trying to cost control and to optimize their cost structure. So cost of revenue and product development expenses as a percentage of revenue is down, while SG&A maintain constant. But I think the bigger concern here is really when you see in terms of an absolute figure, so cost of revenue and sales and marketing expenses actually went up, while product development and general and administrative actually went down year on year. So this is a call for concern because product development in the grander scheme of things would be R&D that is engaged by many of these tech companies. I would definitely not hope that in order for Alibaba to cut back on expenses, they're gonna give up innovating and planning for the future. But this is just numbers from one quarter, so we have to keep our eyes peeled. Now moving on, in terms of share-based compensation, it's actually declining very meaningfully. You can see that total share-based compensation was down from 6.7 billion renminbi to negative 1.6 billion. And you've heard it right, negative 1.6 billion. So they did split it up into the three different segments. I'm going to exclude others. So you can see on Alibaba Group specifically, it's still down on an absolute level from 5.6 billion to 4.2 billion. That said, I think in terms of why is there such a huge reduction, it's really because of Ant Group. So Ant Group share-based compensation was from 25 billion to negative 6.8 billion. And as the disclosure puts it, this is a result of a mark-to-market adjustment during the quarter relating to Ant Group share-based awards granted to our employees because of a decrease in the value of Ant Group. And I think share-based compensation is really a double-edged sword. It really works only when the share prices of your underlying companies just keep going to the moon, vertical 45 degrees to the right. And in this case, I think from the recent disclosure, Ant Group actually wishes to buy back their shares at a relatively low valuations. And they did disclose that in July 2023, Alibaba actually received notice from Ant Group of a shareholder meeting to approve, among other things, of a proposal to repurchase from its shareholders up to 7.6% of Ant Group's equity interests, with an equity value of around $567 billion RMB. So this was definitely a far cry from the peak valuation when Alibaba wanted to IPO Ant Group back in 2020. So because of this huge reduction in valuation, most of the employee share-based compensation under Ant Group essentially lost value, and that's why they had to write down, which is why there's this huge reduction. But that said, I think firstly, this is unhealthy. Because if you would like to incentivize your employees and want to give them skin in the game, if the share price of your company just keep going down, then none of this share-based compensation will be vested into equity, and this incentive structure will be flipped on its head. And secondly, I definitely do not wish the companies that I own print shares like it's free at the expense of shareholders because it has a dilutive effect. So it's really very hard to strike the balance. But fortunately, in this recent disclosure, where Ant Group wishes to buy back around 7.6% of their equity interests, Alibaba is not strong-armed into giving in and selling back their stake to Ant Group, and they did say that they're going to decline the offer. So a good thing is there's actually no foul play involved. Foul play being maybe the Chinese government is speculated to ask Alibaba to divest their Ant Group position. But at least from this perspective, you can see that there's no foul play. And Alibaba still retains one of its crown jewel in this entire business, which is Ant Group's position. And on top of that, Alibaba has also recently repurchased 3.1 billion in the latest quarter, and this actually leaves them with around 16.3 billion authorized good till March 2025. Now, moving on to the specific segment of Taobao and Tmall. In terms of top-line revenue growth rate, they have grew 12% year-on-year, and this is supported by very strong recovery in terms of customer management revenue, which grew 10% year-on-year, and also direct sales, which grew 21% year-on-year. So in terms of their focus, the management team actually gave 3 key focus, which is increasing media content by strengthening engagement, enhancing price competitiveness through targeting a new marketing feature, and also catering to time-sensitive needs. So I think just to zero into the first focus, which is increasing media content, they're essentially rolling out a slew of different content management tools and really penetrating into the new forms of engagement, like live streaming, for example. So this is essentially how Alibaba is trying to retain users and to grab market share, particularly so the mind share of many of their customers. So customer management revenue actually increased primarily due to the increase in merchants' willingness to actually invest in advertising, and also we can see that there's a great recovery and there's an increase in online GMV, gross merchandise value, which is reflective of a successful 618 event, which happens to fall in the particular quarter. So strong sales was also driven by consumer electric indirect sales, and Taobao actually grew daily active users by 6.5% year-on-year. And according to Statista, Taobao actually has 892 million monthly active users. I can't really search out for daily active users figures, but take it for what it is and triangulate your own data points. So Xianyu, which is their platform that focuses on second-hand products, very much like Carousell in Singapore, they grew their daily active users by 18% year-on-year. And I put a note here, this is my own opinion, this is very reflective of the Chinese economy today, because there is a transition where customers are placing much more emphasis on the value of the products. So which is why when we triangulate our data points, you can see that Pinduoduo experienced a great deal of growth because they are essentially catering to the lower rung of the population, while on the flip side, JD.com is experiencing a very major slowdown in terms of their growth because they focus on the much higher rung of the population. On top of that, 88 VIP members, which is very much like Amazon Prime, also grew double digits. And if they didn't announce the numbers specifically, it should mean that it's in the low teens. Because you can see that if it's anything above 15%, they do like to reflect the numbers in their earnings report. Now, moving on to international commerce, their order growth was also up 25% year-on-year. Losses actually narrowed. Adjusted EBITDA actually grew 70% year-on-year. They did cite it because of improving margins. Trendyol, which is their Turkey business, actually achieved positive operating results, and Lazada also improved monetization. So I think I did put a note here where Trendyol, their Turkey business, is a dark horse. You can see that many of their numbers, year-on-year growth rates is spectacular, and it is also not coming off the backs of very low base growth. So this is 15.7 billion RMB to 22.1 billion RMB, and it is still growing from strength to strength. So I'm starting to pay closer attention to the international commerce business, which is specifically Trendyol. And on the flip side, I think Lazada is just going to continue cruising around, and the competition between them and Shopee, I don't really hold much optimism. So for AliCloud specifically, they did move around some numbers. So for the June 30th 2022 figures, they only reported a revenue of around 17.6 billion. And this year, when they did a comparison year-on-year, they did boost it up to a much larger figure, which is 24.1 billion. Year-on-year growth rate 4% to 25 billion. So profitability currently looks good, but firstly, you need to see whether it's sustainable because they did some adjustments and classifications. And secondly, it's really the top line growth rate that many investors are concerned with. So in terms of the discussion, management in the earnings call, there's a lot of AI talk. So for me, personally at least, I only believe in numbers and growth is still lackluster at best. So DingTalk, which is basically their Teams or Slack's equivalent, seems interesting. They recently just integrated their own ChatGPT function. It's, I think, 同义千文. And right now, I'm squarely focused in understanding the impacts in delivering numbers, numbers specifically growth rates, and also profitability. So I think the bottom line is, I think investments in the cloud transition has not come back from the private enterprises. So it's still something that we need to look into. So moving on to local services, order growth was 35% year-on-year. So Ele.me benefited from improving consumer demand, number of active merchants and delivery capacity. More importantly, their unit economics per order is positive and their order density actually improved. So you can see that revenue actually grew year-on-year very nicely, which is supported by the order growth. Moving on to Cainiao, which is their logistics business, they actually benefited from the international capacity, and they recently launched their flagship service of 5-day global delivery. Now, moving on to the earnings call, these are a few highlights that I wish to kind of discuss here so that you can save your time. So at least indicated by the latest macroeconomic data, there's still uncertainties about the post-COVID recovery. You can see that in terms of the share price, it speaks the same story and they tell the same tale. After the recent COVID lockdown restriction being lifted, you can see that there's a huge rally at the start of the year, and then they all started being muted down and normalized downwards. For now, you can see that economic and consumer activities continue to resume, and it's evident from Alibaba's own financial numbers. So Taobao's July growth was actually over 7%, more than the 6.5% that was reported in the earnings. So daily active users' leadership in the e-commerce space continue to widen across their competition. So they recently also launched a value for money battle, which they onboarded large number of new merchants, which converted many users. And you can see that the conversion comes in terms of 88 VIP subscription, in terms of GMV recovery, etc, etc. So they launched this event called the Taobao Good Price Festival during 618 in promoting value for money offering and to attract new users from lower tier cities. So I probably need to cross-check this with Pinduoduo's growth because by attracting new users from the lower tier cities, I don't know whether they are generating new users or whether they are stealing market share from Pinduoduo. So on top of that, they also started pumping the AI term. As we know, companies that talk more about AI, their share price increase even more. I don't really like that necessarily. Growth for Ali Cloud was also negatively impacted by the normalization of demand on video streaming, remote working and learning when offline activities actually resumed. But the management team did say that they received strong demand for model training and AI-related services on cloud, which were partially fulfilled due to near-term constraints. So growth rates might actually be short-term impaired because of these concerns. And as investors, we probably want to take a longer-term view. Now, moving on, when asked about KPI, Trudy, who's the CEO of Taobao, actually focused on user and merchant scale. So really, it's about daily active users, number of merchants on their platforms, etc, etc. So their paying users is also an increasing proportion coming from the lower tier cities, younger people, and older consumers that have been on their platform for some time. So Daniel, who is the group CEO, stepping down and he's taking over the cloud segment, gave a non-answer on when we can expect cloud growth to re-accelerate. So the focus of cloud is quite clear, at least from his response. He says that he wants to help cloud partners to use their foundational offering to fine-tune and build their own model, customized for their business, like hosting for Meta. So the focus on cloud expansion would be internet companies, which also explains the stalling of growth because over the last 2 years, there is this broad-based tech crackdown and many internet companies were essentially massacred, which squares very nicely into telling the story of why Ali Cloud growth is essentially stalled, and which is why we need to keep a close eye on the numbers on how Ali Cloud is going to deliver. Because we don't want to be sales talk by the management team into how big the total addressable market of cloud is, but they are unable to deliver in terms of growth rates and profitability. Because at the end of the day, let's not forget that it's earnings that drive stock prices. Moving on to the balance sheet, it's a very, very rosy picture. Alibaba is in a very, very strong and good position. Touch wood, unless they're going to be forced and strong-armed to donate to the Chinese government. If not, this is as good a balance sheet as any investor can ask for. So on Friday, the 11th of August, Alibaba actually closed at $95 a share, and that signifies around a $243 billion market cap. So in the latest quarter, Alibaba actually disclosed a net cash position of $57.8 billion US dollars. $57.8 freaking billion dollars on a $243 billion market cap. So if you net their cash out, they currently sit around $185 billion, and that's $72.87 per share. So it means that their current stock price of $95, $22.85 per share is in cash. And their cash position actually increased by 5% quarter on quarter. Alibaba is showing investors time and time again what a cash cow and cash printing monster they are. Now, moving on to cash flow, their capex actually did drop quite a fair bit from $11.1 billion down to $6 billion. This might be or might not be a call for concern. I think you have to take a much longer trajectory view. So I'm definitely not in favor of companies cutting costs at the expense or at the sacrifice of their future growth rates. So we have to keep a closer eye on whether the result of such a cutting cost measure will cause Alibaba to slowly lose their competitive advantage over their competitors. But that said, I think from a free cash flow profile figures, Their peak FCF, trailing 12 month, was around $35 billion in March of 2021. So in terms of the FY 2023 results, which is until March of 2023, which is the previous quarter, their trailing 12-month free cash flow is around $25 billion. And currently, their trailing 12-month free cash flow is $27 billion. So the $240 billion at market cap, that's an 8.88% free cash flow yield. What? That's a good number. For those of you who don't know, for the Chinese, they love the numbers 8. So at $185 billion, if you reduce their net cash position, that's a 14.6% free cash flow yield. So I don't need to further elaborate and debate on whether Alibaba is at an attractive valuation today. The numbers speak for themselves. Moving on, in terms of growth expectations, you can see that earnings has been revised downwards over the last, say, 2 years. But you can see that there's this slight increase where investors or analysts on Wall Street is starting to get optimistic again. So you can see in terms of the year-on-year percentage growth rates for the following 3 years, it's between 8 to 14, 15%. So yeah, it's in the very sweet spot of 8 to 12%, which I'm constantly on the lookout for. Moving on, at least for the revenue expectations, they are still expecting for Alibaba to hover around the 7 to 10% mark. But I think to just give you an understanding of what Wall Street is currently expecting, you can see that in March 2028, the consensus is that Alibaba is going to grow their revenue to $166 billion. Right now, they are doing around $126 billion. So if you just do a Kager calculator, they are essentially expecting Alibaba to grow top-line revenue growth rate by 5.6 or 5.7%. So you be the judge on whether you think this is optimistic, this is pessimistic, or this is right in line. To me, I think this is extremely conservative numbers. I do believe that Alibaba is going to grow much faster than 5.7% over the next 5 years, but we'll see. So all these right now are just guesstimates. So to round up this latest quarterly earnings, I have 3 key pointers. Firstly, China's growth story is not dead, and Alibaba, which is an extension of China's consumption, it's showing good figures. Margins are trending in the right direction. Revenue growth rates have started re-accelerating. Point number 2, valuations remain extremely attractive if you were to believe the numbers on face value. Of course, for the skeptics out there that say that China only reports fake figures, then it will render the discussion moot. And point number 3, we need to see whether this growth story is sustainable or not, or whether is it just a 1 quarter recovery and then we go back downwards again. So that's probably why people are still kind of skeptical. So unless you can see the sustained earnings growth, sustained margin retention, then maybe investors will get excited again. So of course, investors are only interested in one thing, which is the stock price. You can see that after Alibaba reported their earnings, they have a huge rally around 7 to 8% on one day. And then on Friday into the closing, Alibaba actually dropped by around 4 to 5%. So why? For those of you who are interested, I might release the part 2 of this video to explain why I think the market has reacted so negatively after reacting so positively. With that, the bottom line is, I think Alibaba has posted great results in this most recent quarter, and I look forward to more optimism ahead. And I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye!